There's an uncomfortable truth that very few traders ever come to accept. The more you trade, the less money you usually make. This statement sounds completely backward to most people who enter the market. After all, the logic seems simple. If one trade makes you money, then 10 trades should make you 10 times more. But in the real world of trading, that mindset is exactly what keeps most traders broke, stressed, and stuck in cycles of emotional chaos. Consistent profitability in trading has very little to do with how many times you click the buy or sell button. It's about how well you understand your psychology, your probabilities, and your ability to wait. The best traders don't trade every opportunity they see. They trade only when conditions align with their strategy, and they have complete psychological control. Trading less is not a sign of fear or hesitation. It's a sign of mastery. It's what separates the amateurs who chase action from the professionals who control their impulses and let the market come to them. Overtrading is one of the biggest reasons traders fail. It's not just a technical problem, it's a psychological addiction. The market moves constantly, and every candle that forms can make you feel like you're missing something. There's an urge to participate in every move, to always be doing something. But that's the trap. The feeling that you must always be in a trade to make progress. In reality, most successful traders spend more time watching than they do trading. They know that not every setup deserves their attention and not every opportunity is worth the risk. Overtrading stems from emotions, fear of missing out, greed for quick profits, frustration after losses, and the illusion of control. When you see price moving without you, it's easy to feel left behind, and that emotion drives impulsive decisions. You start entering trades that don't fit your plan, forcing setups that aren't really there, or increasing position sizes to make it back. What starts as one mistake often snowballs into a series of bad trades. Every impulsive click erodes not just your capital, but your confidence. The problem isn't that traders can't find good setups, it's that they can't stay out of bad ones. The human brain craves activity and reward. Trading provides both constant feedback, flashing screens, profits, and losses. It's stimulation. But that stimulation becomes addictive, and like any addiction, it can lead to self-destruction if not controlled. Overtrading is often a symptom of deeper psychological issues, impatience, insecurity, or the inability to tolerate boredom. Learning to trade less is about reprogramming your mindset to understand that waiting is not wasting time, it's preparation. The truth is, profitability in trading doesn't come from doing more, it comes from doing better. Every professional trader knows that quality always beats quantity. One great trade executed with precision, patience, and discipline can outperform 20 impulsive ones made out of boredom or greed. The goal of trading isn't to catch every move, it's to catch the right ones. The most profitable traders are selective hunters, not constant chasers. Selectivity requires the confidence to say no. It means sitting out when the market isn't clear. It means waiting for the conditions that meet your criteria instead of convincing yourself that this might work. When you trade less but with high conviction, you reduce randomness and emotional stress. You're no longer reacting to every tick of the market, you're acting only when the probabilities are in your favor. There's also a compounding effect that comes from selectivity. By taking fewer trades, you conserve both capital and emotional energy. You avoid unnecessary losses, allowing your winning trades to build your account steadily. Selectivity helps create clarity. When you see fewer setups, you think more clearly about each one. You're no longer playing defense against emotional impulses. You're playing offense with precision. Patience is the most underrated skill in trading. It's easy to talk about, but hard to live by. The reason patience is so powerful is that markets are designed to exploit impulsive behavior. Prices move up and down to trigger emotions greed, fear, and excitement. When you lack patience, you become predictable to the market. You enter early, exit too soon, or overtrade to compensate for boredom. Professional traders understand that most of the time, the market isn't offering a high probability setup. They're okay with waiting. They know that trading less doesn't mean doing nothing. It means preparing, analyzing, and being ready when the opportunity comes. Patience creates the psychological space to think clearly and act rationally. It allows you to detach from the need to make something happen and instead focus on executing when conditions are right. Patience also builds mental resilience. Every time you resist the urge to overtrade, you strengthen your discipline. Over time, this discipline compounds into confidence. The best traders in the world aren't the most active, they're the most patient. They understand that real wealth in trading comes not from constant activity, but from controlled execution at key moments. Trading less is a form of emotional control. It's proof that you're not letting your impulses dictate your behavior. The moment you feel the urge to trade for the sake of trading, that's your signal that emotions are taking over. The most dangerous emotional states for traders are overconfidence after a win and desperation after a loss. Both lead to impulsive decisions that violate discipline. Emotional discipline means sticking to your plan regardless of what's happening in the market. It means accepting that missing a trade is better than forcing a bad one. It's understanding that being flat, not in a trade, is also a position. Every time you skip a low-quality setup, you're protecting your capital and preserving your mental clarity. Impulse control is what separates professionals from gamblers. Gamblers act on emotion, professionals act on evidence. One simple but powerful method to build impulse control is the two-step rule. When you feel the urge to trade, pause for 2 minutes. During that time, review your plan and checklist. If the setup doesn't align with your criteria, walk away. That pause breaks the emotional pattern, giving your rational mind time to take back control. The numbers don't lie. Traders who trade less often tend to make more money. Studies on professional traders show that reducing trade frequency improves accuracy and consistency. This isn't a coincidence. It's statistical reality. When you take fewer trades, you reduce exposure to random noise and market volatility. You give your edge room to play out without emotional interference. Overtrading leads to overexposure, too many trades, too much risk, and too many emotional decisions. Every trade carries transaction costs, both financial and psychological. The more you trade, the more you pay, in spreads, commissions, and stress. By trading less, you lower your total risk exposure, giving your winners more power to compound over time. Think of trading like baseball. The best hitters don't swing at every pitch, they wait for the perfect one. They know their sweet spot and only act when the conditions are right. The same applies to trading. When you take only high-quality setups, your win rate improves, your losses shrink, and your confidence grows. The compounding effect of fewer, better trades creates long-term stability. Becoming profitable in trading means shifting your focus from profit to process. Most traders obsess over outcomes, how much they made or lost. But professionals know that the outcome is just a reflection of the process. When you focus on executing your strategy with consistency, the profits follow naturally. Trading less helps reinforce this mindset because it forces you to prioritize quality and discipline. A process-driven trader has a plan. They know what setups to look for, what conditions must be met, and when to stay out. They review their trades objectively, not emotionally. This structured approach removes the chaos from trading. It transforms it from gambling into a systematic business. Your process should define everything, from when you trade to how you manage risk and when you stop. When you have a defined structure, You stop second-guessing yourself. You no longer need to constantly be in a trade because you know your plan will eventually bring opportunities. Trading less allows you to focus on execution over excitement, and that's where consistency begins. Professional traders don't wake up and randomly decide what to trade. They have routines daily, weekly, and monthly. They start their day by analyzing the markets, reviewing economic news, and identifying key levels. Then they wait. They understand that 80% of trading is preparation and only 20% is execution. Their waiting time isn't wasted, it's used for journaling, studying, refining strategies, or reviewing past trades. Professionals understand that doing nothing is part of the job. Trading less doesn't mean being lazy. It means using your time strategically. The market rewards patience and preparation, not impulsive action. Most amateurs think trading is about activity, but professionals know it's about observation. They let the market reveal its hand before acting. They don't try to force trades, they react only when their setups align perfectly. Their day is built around discipline, structure, and clarity, not chaos or adrenaline. Observation is the secret weapon of great traders. The more you watch the market without reacting, the more you understand its rhythm and behavior. Observation builds intuition, not the kind based on guessing, but on pattern recognition developed through discipline and patience. By trading less and observing more, you train your brain to recognize quality setups instantly. Observation also reduces stress. When you're not constantly in trades, you're able to analyze the market objectively. You're detached from the emotional roller coaster that comes with live positions. You see things others miss because they're too emotionally invested. This clarity helps you make better decisions and develop sharper judgment. The greatest traders spend most of their time studying, not trading. They know that profits come from understanding market context, not chasing candles. Trading less gives you the space to think, analyze, and evolve, which, in the long run, makes you more consistent and profitable. Consistency in trading is built over time, not overnight. The traders who last are the ones who treat trading as a long-term game of mastery, not a short-term rush for profits. The less you trade, the more control you have over your emotions, your risk, and your long-term growth. Every trader goes through emotional cycles: excitement, frustration, confidence, and doubt. The key is to manage these cycles without losing discipline. Trading less helps stabilize your psychology. It prevents emotional fatigue, reduces stress, and allows for clearer decision-making. Over time, this stability compounds into real mastery. Mental maturity is the foundation of consistent profitability. It means accepting that missing a trade is okay. It means understanding that the market will always provide new opportunities. It means realizing that the goal isn't to trade every day, it's to trade well. The traders who understand this principle are the ones who last the longest and profit the most. The truth about trading psychology is simple but powerful. The less you trade, the more you make. Not because you're doing less work, but because you're doing the right work. Trading less forces you to think clearly, act deliberately, and trade only when it truly matters. It aligns your mind with the principles of patience, discipline, and probability. Every great trader eventually learns that mastery isn't about constant activity, it's about controlled precision. The amateurs trade to feel excitement. The professionals trade to execute edge. Trading less isn't a weakness, it's a superpower. It's the point where you stop being a gambler and start being a strategist. So, if you want to truly make money in trading, stop asking how many trades you can take in a day. Start asking how many high-quality trades you can wait for in a month. Because in trading, the goal isn't to trade more, it's to trade better. And that's the truth about trading psychology that most people will never understand.